In March 2009, I received a letter from a man named Robert. He was 72 years old. He'd worked for 43 years as an engineer, saved diligently, accumulated $1.4 million by 2007. He'd done everything right. Every financial advisor praised his discipline. His portfolio was diversified, or so he thought. 18 months after he retired, he had $380,000 left. Not because of bad luck, not because of fraud, because of 6 specific decisions he made in retirement that violated principles I'd spent 50 years learning. I'm going to tell you what those decisions were because if you're over 60, there's a high probability you're making at least 3 of them right now. Robert's story haunts me because it was preventable. Every mistake he made came from conventional wisdom. Every decision seemed logical at the time. His financial advisor approved every move, but conventional wisdom in retirement isn't wisdom at all. It's a collection of assumptions that work in normal times and destroy you in abnormal times. And here's what 5 decades of watching market cycles has taught me. Abnormal times aren't the exception. They're the rule. We just forget this during the calm periods. Let me show you what this means for your money right now. Before I continue, I need to know who I'm talking to. What's your biggest fear about retirement? Running out of money? Market crashes? Healthcare costs? Drop your answer in the comments because understanding your specific concern helps me address what matters most to you. And if you're serious about protecting what you've spent a lifetime building, subscribe now. This channel isn't about beating the market or finding the next hot stock. It's about second-level thinking, the kind of analysis that's protected wealth through 8 major market disruptions since I started at Citicorp in 1969. The difference between first-level thinking and second-level thinking is often the difference between comfort and catastrophe in retirement. Now, here's what I'm going to show you in the next 15 minutes. The 6 mistakes that destroy retirement portfolios, why each one seems logical but isn't, and the specific framework we use at Oaktree to avoid them. But you have to stay until the end, because the 6th mistake is the one almost nobody talks about, and it's probably the most dangerous. Let me start with what most people get wrong about retirement investing. They think it's about preservation. They've been taught that once you stop working, you shift to bonds and stable income. Every retirement planning book tells them to subtract their age from 110, and that's their stock allocation. A 65-year-old should be 45% stocks, 55% bonds. Simple formula, widely accepted. But here's what 40 years of managing money through multiple cycles actually shows. The biggest risk in retirement isn't volatility, it's running out of money. And the surest way to run out of money is following conventional asset allocation formulas without understanding the cycle you're in or the sequence of returns you'll experience. This isn't opinion, this isn't theory, this is pattern recognition across 7 market cycles, 4 major crashes, and watching hundreds of retirees navigate these waters. Some made it through wealthy, others didn't. The difference wasn't luck, it was avoiding 6 specific mistakes. I'm going to break these down from most catastrophic to most subtle. Each one builds on the last. Make the first mistake and nothing else matters. Avoid all 6 and you'll sleep soundly regardless of what markets do. Let's start with the mistake that destroys everything. The first mistake is selling into panic. This seems obvious, right? Everyone knows you shouldn't sell at the bottom. But here's what most people don't realize. You don't decide to sell at the bottom. You decide to sell because you're terrified, and terror feels like wisdom in a crisis. Robert made this mistake in October 2008. The S&P 500 had dropped 40% from its peak. Every financial news channel showed apocalyptic scenarios. His portfolio had fallen from $1.4 million to $920,000. He couldn't sleep. His wife was crying. Their advisor said, let's move to safety until things stabilize. They sold everything on October 15, 2008. The market bottomed 5 months later and then went on the greatest bull run in history. If Robert had done nothing, literally nothing, his portfolio would have recovered to $1.4 million by 2011 and grown to over $4 million by 2020. Instead, he locked in his losses and never participated in the recovery. This wasn't stupidity. This was first-level thinking. First-level thinking says, the market is crashing, I'm losing money, I need to stop the bleeding. Second-level thinking asks, where are we in the cycle? What's priced in? What's the cost of being wrong about timing the re-entry? Robert never asked those questions. His advisor never asked those questions. They made an emotional decision that felt logical and destroyed his retirement. I see this constantly. In March 2020, During the COVID crash, I received dozens of emails from retirees asking if they should sell. The market had dropped 34% in 3 weeks, the fastest decline in history. Every headline screamed catastrophe. But here's what I wrote back to every single one. What has changed about the fundamental value of the businesses you own? Are people going to stop using technology, stop consuming products, stop needing healthcare? The answer was no. The businesses were fine, the prices were wrong. Panic selling is always selling good assets at bad prices because fear overwhelms analysis. At Oaktree, we learned this lesson painfully in the 1990s, not from selling in panic, but from watching others do it and recognizing the pattern. During the Asian financial crisis in 1997, we saw institutional investors, sophisticated people with teams of analysts, dump high-quality Asian debt at 30 cents on the dollar because they couldn't handle the volatility. We bought it. We held it. It recovered to par within 3 years. The sellers locked in 70% losses. We made 230% returns. Same assets, different thinking process. Now here's the second level insight. The best time to sell is when you don't need to, and the worst time to sell is when you feel you must. If you're selling because you're scared, you're selling at exactly the wrong time. The market is designed to inflict maximum pain at the bottom. That's when fear is highest. That's when prices are lowest. That's when you should be doing the opposite of selling. So what do you actually do? You build a plan before the crisis. You decide in advance how much volatility you can psychologically handle. You keep 2 to 3 years of living expenses in cash or short-term bonds so you never have to sell stocks in a crash. You write yourself a letter during calm times explaining why you own what you own and what would have to change fundamentally, not just in price, for selling to make sense. When panic hits, you read that letter. You follow the plan. You do not improvise during a crisis. This isn't complicated. But it requires discipline that most people don't have. Most people can't sit still while their portfolio drops 30%. That's why most people don't build wealth in retirement. They destroy it through emotional decisions disguised as prudence. But selling in panic alone isn't enough to destroy a retirement. You can recover from one bad decision. The second mistake is what prevents that recovery, and it's more insidious because it feels safe. The second mistake is staying in cash too long. After you panic sell, you tell yourself you'll get back in when things stabilize, when the uncertainty clears, when you can see the path forward clearly. This sounds rational. It's actually fatal. Here's why. Markets don't wait for clarity. Markets bottom when uncertainty is highest. By the time things feel safe, prices have already recovered 40% or 50%. You've missed the recovery waiting for confirmation that never comes at the right price. Robert made this mistake after selling in October 2008. He sat in cash through all of 2009. The market rallied 65% that year. He kept waiting for a pullback to re-enter. It never came at levels below where he sold. By the time he felt comfortable investing again in 2011, the market was higher than when he originally sold. He'd lost 3 years of compounding and locked in permanent losses. This pattern repeats every cycle. In 2002, after the dot-com crash, investors who sold in 2001 stayed in cash through the entire 2003 to 2007 bull market, waiting for another crash. In 2020, people who sold in March stayed in cash through the fastest recovery in history. They're still waiting for the crash that would justify their earlier decision. I learned this principle in a different context. In 2005 and 2006 at Oaktree, we became increasingly defensive. Credit spreads were too tight. Leverage was too high. Risk wasn't being compensated. We started raising capital for distressed debt funds, anticipating a crisis. Our investors questioned us. Why raise money now? There are no opportunities. We said, we're raising money precisely because there are no opportunities. When opportunities appear, there won't be time to raise capital. The crisis hit in 2008. We had $11 billion in dry powder. We deployed it into the best opportunities we'd seen in decades. Firms that had stayed fully invested couldn't take advantage. They were dealing with redemptions and margin calls. Firms that had gone to cash during the crisis couldn't deploy fast enough. They were paralyzed by fear. We acted because we'd prepared before the crisis, not during it. The second level insight here is about timing asymmetry. The pain of being early is temporary. The cost of being late is permanent. If you move to cash too soon, you miss some upside, but you're positioned for opportunity. If you move to cash during a crash and stay there too long, you miss the recovery and never catch up. What do you actually do? You never go 100% to cash, ever. Even in retirement, even in a crisis, you maintain a core equity position that you never touch, maybe 30% to 40% of your portfolio, no matter what happens. This ensures you participate in recoveries even if your timing is imperfect. The rest of your portfolio can be tactical, but that core position is permanent. It's your insurance against your own fear. And here's the critical part. You decide this allocation now, while markets are calm, not during the next crisis. You write it down. You commit to it. Because when the crisis comes, and another crisis will come, you won't have the emotional fortitude to make this decision rationally. These first two mistakes are about behavior during crises, but the next four mistakes happen during calm periods. They're subtle, they compound slowly, and they're just as destructive because they leave you unprepared for the inevitable crisis. Let me show you the third mistake, and this one surprises people because it sounds like responsible planning. The third mistake is over-allocating to bonds at the wrong time in the cycle. Everyone tells retirees to own bonds. Bonds are safe. Bonds provide income. Bonds reduce volatility. All of this is sometimes true, but bonds are not always safe. And right now, depending on where we are in the rate cycle when you're watching this, bonds might be your biggest risk. Here's what most people don't understand. Bond prices move inversely to interest rates. When rates rise, bond prices fall. If you own a 30-year Treasury bond yielding 3% and rates rise to 5%, your bond loses roughly 30% of its value. You can hold to maturity and get your principal back, but if you're a retiree taking distributions, you might need to sell at a loss. This is exactly what happened in 2022. The aggregate bond index fell 13%, the worst year for bonds since the 1700s. Retirees who thought they were safe in bonds got crushed. I've written extensively about this in my memos on the perils of low interest rates. From 2010 to 2021, with rates near zero, bonds offered no margin of safety. You were taking duration risk, the risk that rates would rise, without being compensated for it. Yet every retirement advisor was still recommending 50% to 60% bond allocations for 60-year-olds. This was following a formula without thinking about the cycle. At Oaktree, we dramatically reduced our duration exposure during that period. We held short-term bonds, floating-rate loans, and alternative credit. We gave up some yield, but we avoided the carnage when rates eventually rose. This wasn't prediction. This was risk management. When you're not being paid to take risk, don't take it. The second-level insight is that asset allocation isn't static. The right allocation depends on where we are in the cycle. In 2010, with rates at zero, bonds were dangerous. In 2023, with rates at 5%, bonds became interesting again. First-level thinking says, I'm 65, so I should own 55% bonds. Second-level thinking asks, what's the risk-reward of bonds today given current rates and likely paths forward? What do you actually do? You assess the cycle before following any formula. If rates are low and likely to rise, you reduce duration. You hold cash, you hold floating rate instruments, you wait for better opportunities. If rates are high and likely to fall, you extend duration and lock in yields. The allocation formula is a starting point, not a commandment. Your job is to adjust based on current conditions. This requires you to understand one simple concept. Where are we in the interest rate cycle? You don't need to predict the future. You just need to assess whether rates are unusually high or unusually low relative to history and position accordingly. Right now, ask yourself, are rates higher or lower than the 50-year average? If higher, bonds are more attractive. If lower, be cautious. It's not complicated, but most people never ask the question. The fourth mistake builds on this cycle awareness, but it's about equities instead of bonds, and it's the mistake that causes retirees to miss the best opportunities of their lives. The fourth mistake is avoiding stocks when they're cheap because you're too old to take risk. I hear this constantly. Someone turns 65, and suddenly they think they can't own stocks because they don't have time to recover from a crash. This is backwards thinking that costs people millions. Here's the reality. If you retire at 65, you likely have a 25-year time horizon, maybe longer. That's longer than most people's working careers. You're not investing for next year. You're investing for the next quarter century. And over any 25-year period in history, stocks have dramatically outperformed bonds. Not sometimes, always. But here's where it gets interesting. The best time to own stocks is when they're cheap, and the only time stocks get really cheap is during crashes when everyone is terrified. This is exactly when retirees panic and sell because they think they can't afford the volatility. They're giving up the best opportunities right when they should be leaning in. In March 2009, with the S&P 500 at 666, I met with a 70-year-old investor. He'd sold everything in late 2008. He asked me if he should get back in. I said, stocks are trading at valuations we haven't seen since the early 1980s. If you have a 15-year time horizon, and at 70 you probably do, this is the opportunity of your lifetime. He didn't buy. He was too scared. He missed a 400% return over the next decade. At Oaktree, we deployed more capital in 2008 and 2009 than in any period in our history. We weren't smarter than everyone else. We just understood where we were in the cycle. Valuations were compelling. Fear was extreme. That's when you buy, regardless of your age. The second level insight here is about risk versus volatility. Most people confuse them. Volatility is price fluctuation. Risk is permanent loss of capital. In 2009, stocks were volatile but not risky. They were trading below intrinsic value. In 2021, stocks were less volatile but more risky. They were trading above intrinsic value. Your job as a retiree isn't to avoid volatility. It's to avoid overpaying for assets and to buy when others are panicking. What do you actually do? You maintain equity exposure throughout retirement. The percentage varies based on the cycle, maybe 40% when stocks are expensive, maybe 60% when they're cheap, but you never go to zero. And critically, you increase your stock allocation when everyone else is reducing theirs. This feels impossible in the moment. That's why you need a framework decided in advance. Here's the framework. Measure valuations. Look at the CAPE ratio, price to book, price to sales. When they're in the bottom quartile, historically, increase equity exposure. When they're in the top quartile, reduce it. This isn't market timing. This is cycle awareness. You're not predicting when the market will turn. You're positioning based on risk-reward today. Now we're getting into the more subtle mistakes. The fifth one is about income, and it's costing retirees hundreds of thousands of dollars without them realizing it. The fifth mistake is chasing yield without understanding risk. Retirees need income. They're not working anymore, so they gravitate toward anything that pays a high dividend or interest rate. High-yield bonds, dividend stocks, REITs, MLPs, preferred shares. If it yields 6% or 8% or 10%, they buy it. This feels like smart income investing. It's actually a recipe for permanent capital loss. Here's the principle. There's no free lunch in markets. If something yields 10% when treasury bonds yield 4%, there's a reason. Either the income is unsustainable or the principal is at risk, or both. You're not getting paid 10% for nothing. You're getting paid for risk you might not understand. I saw this devastate retirees in 2008. They'd loaded up on high-yield bond funds and preferred shares from financial companies, attracted by the 8% to 10% yields. When the crisis hit, those securities fell 60% to 80%. The income stopped. The principal evaporated. They'd been reaching for yield and got permanent losses instead. The same pattern played out with mortgage REITs in 2020. With energy MLPs in 2015, with emerging market bonds in 2013. Every cycle, there's some high-yielding security that looks attractive until it doesn't, and retirees desperate for income pile in at exactly the wrong time. The second level insight is that total return matters more than yield. A stock that yields 2% but grows its dividend 7% annually will produce more income over 15 years than a stock that yields 8% but cuts its dividend in half during the next recession. You want growing income, not just high income, and growing income comes from sustainable business models, not financial engineering. What do you actually do? You build a diversified portfolio of high-quality businesses and bonds that produce moderate but sustainable income. Maybe you get 3% to 4% yield. Then you supplement that by selling small portions of your portfolio systematically, maybe 1% to 2% per year. This gives you the 5% to 6% total distribution you need without reaching for unsustainable yield. It's less exciting. It's more sustainable. That's the trade-off. And here's what you never do. You never invest in something just because it has a high yield without understanding exactly where that yield comes from and what risks you're taking to get it. If you can't explain the source of the yield in 3 sentences, you don't buy it. We're at the final mistake now, and this is the one that almost nobody talks about. It's not about portfolio construction. It's not about market timing. It's about something more fundamental that determines whether your retirement plan works at all. The sixth mistake is underestimating longevity and healthcare costs. Most people plan for retirement as if they'll live to 85, but if you're 65 today and in reasonable health, there's a 50% chance you'll live past 90. There's a 25% chance you'll live past 95, and healthcare costs in your 80s and 90s will be multiples of what they are in your 60s and 70s. This isn't a market risk, this is a planning risk, and it's the one that causes people to run out of money even if they avoid every other mistake. Robert, the engineer I mentioned at the start, made this mistake too. Even after he recovered some of his losses, he spent as if he'd lived to 85. He lived to 93. The last 5 years of his life, he was dependent on his children because his money ran out. The math here is brutal. If you retire at 65 with $1 million and spend $50,000 per year, you're assuming a 5% distribution rate. That works if you live 20 years. It fails catastrophically if you live 30 years, especially once you factor in healthcare costs that can run $10,000 to $20,000 per year in your 80s. I've thought about this extensively in my own planning. I'm in my 70s now. I've watched friends run out of money. I've watched others die with far more than they needed. The ones who got it right were the ones who planned for living to 95, even if they didn't expect to. They kept their distribution rates around 3% to 4%. They maintained equity exposure for growth. They kept a cash cushion for healthcare surprises. They didn't live extravagantly in their 60s and 70s, which gave them security in their 80s and 90s. The second level insight is that the biggest risk in retirement isn't market volatility, it's outliving your money. And the way you mitigate that risk is by spending less than you think you can afford in your early retirement years and maintaining growth assets longer than feels comfortable. This requires discipline that goes against every instinct. You've saved for 40 years. You want to enjoy it. But enjoying it too much too soon is how you end up broke at 90. What do you actually do? You calculate your distribution rate based on living to 95, not 85. If that means spending less in your 60s, so be it. You maintain at least 40% equity exposure throughout retirement to generate growth that offsets inflation and longevity. You keep a dedicated healthcare reserve, maybe $100,000 to $200,000 in conservative investments that you don't touch except for medical expenses. And you revisit your plan every 3 years to adjust for actual spending and market performance. Robert's story, the one I started with, was really about all 6 of these mistakes compounding. He panicked and sold. He stayed in cash too long. He'd over-allocated to bonds before the crash because someone told him he should. He avoided stocks when they were cheap because he thought he was too old. He'd reached for yield in the years before retirement, which made his crash losses worse. And he underestimated how long he'd live. No single mistake destroyed him. The combination did. That's where we started. Now you understand how it happened, and more importantly, how to avoid it happening to you. Retirement investing isn't about following formulas. It's about understanding cycles, managing risk, controlling behavior, and planning for uncertainty. I've spent 50 years learning this. I've made mistakes, different ones than Robert, but mistakes nonetheless. I've watched market cycles destroy the unprepared and reward the disciplined. And I've distilled it down to these 6 principles. You now know what took me decades to learn. You have an advantage. The question is, will you use it? Because here's the reality, knowing these mistakes isn't enough. You have to build systems that prevent you from making them. You have to write down your plan before the next crisis. You have to commit to discipline when every instinct says to panic. Most people will watch this video, nod along, and change nothing. They'll make the same mistakes. They'll get the same results. Don't be most people. Drop a comment right now with your biggest fear about retirement. Not for me, for you. Writing it down makes it real. Acknowledging it is the first step to addressing it. And subscribe if you haven't already, because this channel is about thinking differently about risk, about cycles, about behavior. This is about protecting what you've built over a lifetime. Markets will crash again. Cycles will turn. Fear will overwhelm logic. But if you've internalized these 6 principles, you'll survive what destroys others. You'll sleep soundly while others panic. You'll build wealth while others preserve poverty. That's what 50 years of investing teaches you. That's what surviving 8 market cycles shows you. That's what managing $180 billion at Oaktree proves. Retirement security is possible, but only if you avoid the mistakes that cost people everything. I can't do it for you. I can only show you how. The rest is up to you.